One of the most overlooked areas of financial analysis is capitalization, the types of financing a company uses to fund operations and growth. There are two types of capitalization, equity and debt. Equity capitalization is the value of issued and outstanding stock and retained earnings, and debt capitalization consists of long-term loans, notes, and bonds, in other words, borrowed money. The higher the level of debt capitalization, the higher the level of profits that have to be spent in debt service, that is the repayment of loans. The higher the interest a company has to pay, the less capital remains for expansion and dividends. So as debt rises, the relative impact of equity declines and stockholders have less of a chance of future growth. From a manager's point of view, increasing debt means more negative impact on cash flow. At some point, the level of debt can take on such a prominent role that it becomes impossible ever to reverse the trend. Growing levels of debt are a huge problem for any company interested in growth and in maintaining a return on revenues and equity. For this reason, analyzing and tracking the trend in total capitalization is one of the most important and revealing tests of a company's health that you can perform. For a manager, controlling debt is simply good cash flow control. As an investor or potential investor, observing the long-term trend tells you whether the company is growing in positive directions or allowing itself to be gradually consumed by growing debt. The most effective test of how a company is financing its operations and of the trend underway is to monitor the debt ratio. This is a test of the level of debt as a percentage of total capitalization. The formula tracks this on a percentage basis. Long-term debt divided by total capitalization. Here is the example. A company you are tracking reports total capitalization of $42,950,000 US. Long-term debt is $13,030,000. Find the debt ratio. Let's see this in another example on a spreadsheet. Here is the example. Long-term debt, total capitalization, and the debt ratio is long-term debt divided by total capitalization, in this case 30%. The example demonstrates that the company is employing about 1/3 long-term debt and 2/3 equity to finance operations. Is 30% too high? That depends on the industry standard and other factors. For example, if the company is in an industry demanding high inventory levels or the purchase of capital assets every year, a relatively high debt ratio has to be expected. The most important test is the trend, not just 1 year's debt ratio. Is the company maintaining the same level or a declining level of debts as a percentage of total capitalization each year? Is the relationship between debt and equity remaining the same or declining while revenue and profits are growing? One danger sign is a growing debt ratio during periods of expansion. In the worst case, the revenues grow every year and the debt ratio also grows, while net profits remain the same or decline. That is a sign of poor cash flow management. The debt ratio also should be tracked along with the current ratio as a comprehensive test of management and its cash flow policies. Knowing that investors and analysts pay a lot of attention to the current ratio while too often overlooking the debt ratio, company management often finds it tempting to use long-term debt to artificially bolster the current ratio. This ploy creates the impression that the company is managing cash flow effectively when it is actually losing control. And here is another example. A corporation has reported net losses in the past 3 years here, but it has managed to maintain a current ratio of 2. Based on this, some analysts are confident that the management is maintaining effective working capital levels, but a more in-depth analysis reveals the opposite. Here are the numbers: net loss, the current assets and current liabilities. An initial analysis limited only to a study of current ratio trend reveals the following positive outcome. This outcome meets the criteria for the current ratio, and at this point, many analysts would end their analysis of cash flow control. However, when you study the debt ratio for the same period, you will find this picture. Here are long-term debts and total capitalization for the 3-year period, and here is debt ratio. This analysis demonstrates that the debt ratio moved significantly higher even while the current ratio remained steady. During periods of net losses, you would not expect to be able to maintain as healthy an outcome, but it is clear that something else was going on in this example. The level of current assets rose at about the same dollar amount as long-term debt each year. The company was committing itself to long-term loans or bonds and using the funds to increase current assets or decrease current liabilities, maintaining the current ratio level even while long-term debt was growing. Without a specific example of how long-term debt and current ratio can be controlled, this explanation might not seem relevant. However, examples can be found in the historical financial reports of some companies. What's the conclusion? Ratios should be studied over a number of years and in some cases, such as in working capital and capitalization analysis, reviewed in conjunction with other financial ratios. The collective value of studying the debt ratio and current ratio together is much greater than tracking either one in isolation.